John, thank you very much for being here. You just heard the rate conversation that we had right now. Things are very much building and coalescing around this consensus for when they start and how deep they go. What exactly does that do for the outlook for the markets overall, specifically in equities?
Well, I think the key message when I look at the most recent data is disinflation is continuing. And this has been going on now for several quarters in a row. So I think the trend is disinflation. And I think that the two-year bond yield is a very important barometer for where the Fed is going with cuts. In fact, if you go back to 1985 and you look at the spread between the two-year bond yield, which is obviously set by the market, and the Fed funds rate, which is set by the Fed, that spread is in the 95th percentile. What does that mean? That means that the two-year bond yield is lower by roughly 100 basis points than the Fed funds. And the reason that's important is because it's telling the Fed they need to cut. And every time you have periods where the two-year bond yield sits below that Fed funds rate, that is the building pressure for the Fed to cut. So I think when you look at that data historically, you've got evidence that at least 100 basis points needs to come out. And the two-year bond yield is going to fluctuate with obviously the health of the economy and the continued inflation reports that we're seeing that come out. And one more comment I make about inflation. Inflation, obviously has a large portion tied to shelter, roughly 1/3 of the CPI. That basket is weighted toward housing, less toward multifamily, single-family housing. The reason that's important, Dom, is that single-family housing actually has been somewhat stickier than folks would have expected because of higher rates. So ironically, higher rates have created more of an inflationary dynamic in single-family housing than I think folks would have anticipated a year and a half ago.
Yeah, there's an argument to be made that if you lowered interest rates, people would actually transact and get deals done more, and the housing market would kind of unlock there. Okay, I get that. Let's talk a little bit about, with that outlook, what exactly is the place to be? Where do you want to go? What goes on the shopping list, so to speak, when it comes to places to take a view on that environment with rates?
Well, so I think that, predicting exactly when the Fed's going to cut can sometimes cause investors to miss the opportunities that are in front of them. When I look at the most significant valuation dislocations in the market, I see these in the yield-sensitive areas. It's in real estate, publicly traded REITs. It's in banking stocks. It's in utilities. I mean, for example, utilities have their biggest yield premium to the S&P 500 going back to 2003. And that's rational, because why would you sit there in higher yielding stocks when you can clip coupons in fixed income, and when you have a growth trend that has been sparked by AI, NVIDIA, and the semiconductor space? But the one cautionary piece of information I would share is that the SOX, or the semi-broader index, that's at an all-time high valuation, and it is being powered by earnings growth. But if there's a slowdown in the economy, that is vulnerable, particularly in some of those higher beta areas. And the lower beta areas are big time on sale. And what I would also comment about some of these areas, REITs, utilities, banks, there have been multiple reasons why these have gotten cheaper. The banks got cheap in March because of a liability crisis, not an asset crisis. What I mean by that is that the dislocation occurred because of higher rates, and that caused issues on their balance sheets. But it wasn't asset quality deterioration like we saw in the GFC. Particularly with the utilities and the REITs, people were, particularly in staples in those areas, people were overpaying for those areas at the end of 22, anticipating the recession in 2023. So I think those areas are the most discounted. I think they offer a lot of upside opportunity, and you get to clip growing coupons if you move into these areas. And I think that's an interesting way for investors to add additional income and appreciation to their portfolio.